Good evening, everyone. Welcome to the Finance and Audit of the Sacramento Metropolitan Fire District. We will open that's our call to order. So it has been done. Would you please call the roll call, Madam Clerk?
Yes, Director Stark,
Here.
Director Clark, Director Jones.
Here.
Thank you. All are present.
All righty. Now we move to public opportunity to discuss matters of public interest within committee scope, including items on or not on the agenda, limited to 3 minutes per speaker. Madam Clerk, do we have any cards? And after that, Art, do we have anyone online?
And no cards, no public comments tonight. Thank you
Okay,
for this
thank
meeting.
you. Moving on. Chair will entertain a motion for consent items.
So moved.
Oh, okay. We have a first and second. Please call the roll.
Yes, Director Stark, Director Clark, Director Jones.
Aye.
Thank you. Motion passes.
Okay. And now we're on to our presentation items 1 and 2. We have Mr. David Toole, our CFO, for both items. Please proceed with number 1, bi-monthly fiscal report through December 31, 2025. And welcome to the podium.
Thank you, ma'am. And good evening, Madam Chair, Directors, Fire Chief House, and members of the public. Tonight, I'll be presenting the bi-monthly fiscal report through December 31. There it is on the screen there. And the presentation report are provided as I typically do to help you monitor the fiscal health of the district, as well as identify deviations from the most recent adopted budget, which in this case is the final budget. When we meet in 2 more months, we'll be referring to the mid-year after that's been adopted. So just a little reference for something, even though we're going to look at mid-year, the next agenda item, the reference for this is final. Okay, so first chart here is total cash balance trends through December 31st. The red line is this year and the green line is prior year, fiscal year 24-25. After 6 months, the impact of Measure O is still pretty evident there. The current year red line is quite a bit higher than last year because of the cash available from Measure O. We're positive $50.4 million at this point in the fiscal year, about $83 million above last year in December 2024. This next slide is total general fund revenues. And the red line is this year, the green line again is prior year, and the blue line we see here is budget, which all the way to the right, you can see the final estimate is $341.7 million general fund for general fund revenues. Now, as indicated by the arrows, actual revenues through December were $161.3 million, which is about $8.5 million more than last year, but relative to the budget, we're actually about $16 million under. So otherwise, did raise alarm. Why is that happening? And we reached out to the county to find out what was happening there. And they instituted a new property tax payment system, and it normally we would receive on January 15th all the payments from the prior July 1 to December 31st. With the system, there was a glitch of sorts, and instead of July 1 to December 31, it was July 1 to December 10th. So we lost about 3 weeks of payments. Well, we didn't lose them; they just weren't included in the transfer. Now, they were collected. They will show up. They've assured us they're going to make the transfer in March, but that's why we have a $16 million deviation that we weren't expecting to see here. And of course, we keep this money with the county anyway, so there's no like interest lost or anything like that. It's just more of a reporting problem for us. So, all right, this next slide is a subset of revenues, EMS revenues. And after 6 months, shown with the red line, we are at $26.9 million. Compared to last year, that's about $1.5 million higher. But we're actually starting to slip below the blue budget line after 6 months for EMS. So that's something we'll actually take a look at in the next presentation. I just wanted to point out that difference right now. Okay, the next 2 slides are PPG-EMT. Oh, sorry, didn't go. There we go. Next 2 slides are PPG-EMT. And this first one is the first 2.5 years of the program separated by quarters rather than show 30 separate lines. It just kind of consolidated into quarters. And what this slide is telling you is the amount estimated that we expected to get over the 30 months has not quite been reached. Those those red bars add up to about 52.1 million. So we're $1.2 million short of what we expected to have over that period. Now, of course, we are still receiving payments going all the way back to the beginning of this on this chart here, all the way to the left. So anticipate that based on the trends and the fact that 5 of those months are now over 100%, that we will reach the full expected amount for that period. Although it may not be an even 100% in every quarter, but the amount expect that milestone to get reached.
And over how much time is that, Mr. Toole?
30 months. 30 months presented here.
Through June, that's prior, but to come out to 100% at the end, what is your anticipated timeline for that?
How long will it take to get the remaining 1.2 million?
Correct.
Can I two bi-monthly
Get
fiscal
back to me
reports?
if this puts you too much on the spot.
Based on
that's
this,
okay.
it could be 2 months from now, but maybe 4 months from now when I'm reporting that.
I think it will be in with this next.
I think it'll be
fiscal
this
year.
fiscal year. Yeah.
This fiscal year?
Within this fiscal year.
That's a pretty good estimate. Thank you, sir.
Yeah. This is the second PPG EMT slide. So this is for the current fiscal year, showing month by month how much collections have matched up into what we thought would be the average estimate per year, about 2.2 million. As you can see in the bullets there, after 6 months, anticipated collections through December, we're anticipated to be 12.8. Actual collections are 13.7. So on a cash basis for this fiscal year, we've already collected $1 million over what we expect. General fund, now switching from revenues to expenditures. Let's see, the slide shows with the blue line is the budget plan total there. Again, the green line is prior year, red is current. After 6 months, general fund expenditures are 200.9 million, which is actually about 18.5 million more than what we had in the budget at this point. This is mainly a timing issue, and we'll see when we get to the mid-year presentation, we're going to smooth this number out and so forth. But this is kind of timing issue at this point in the presentation. The next component of costs is labor costs. And let's see, as you can see on this slide, the 25, 26, the red line and the budgeted blue lines are very close together. As noted on the slide, actual labor costs were $5.2 million higher than last year, almost exactly at the amount budgeted. Labor costs through December were only about $30,000 higher than budget. So very, very close. So that's it for the revenues and the general fund revenues and expenditures. I'm going to do one more general fund slide on reserve balances. Again, we're tracking pretty close to last year. Coming out of our first dry period dip, we're positive 6.8 million versus 28.7 million last year. And that shortfall has to do, somewhat with the property tax issue I mentioned earlier, and that's showing up in our accounts. The purple dotted line shows where 15% reserve would be. It's about 45 million. That's the reserve update. Moving to the California Employers Retirement Benefit Trust and the California Employers Public Pension Trust, the CERPT and the SEPT. The CERPT is a lot of acronyms, is the OPEB, Other Post-Employment Benefit Trust Fund for healthcare. And then the SEPT is the pension side of that. So as shown, the top section is the CERPT, and as shown on the slide, that since inception, the district has contributed 66.4 million of the 111.6 million in CERP value. In the first half of the fiscal year, the total account value in CERT has grown by 9.5%. So annualized 19% return. So things are really taken off in that fund. We're seeing the exact same thing on the SEPT side, even though it's only $1 million in that account. The investment has earned 96,000 in the first 6 months of this fiscal year. So that's, again, around 19%. So gangbusters on our investments. And just report takeaways for this 6 months. So again, cash balances were 116.1 million, due mainly to the Measure O bond proceeds. As those bond proceeds get spent, that difference will start to narrow. With the PPGMT program, approximately 97.3% of anticipated revenue for the first 30 months of the program has been collected, and 25-26 collections of current fiscal year are ahead of forecast. On the general fund expenditure side, expenditures were $2.9 million lower than prior year and 13.9 million below budget. And as previously mentioned, market returns have been very strong for the SEPT and the SERPT. And that is it for the takeaways. And I'll welcome any questions or comments you might have.
Are there any questions or comments from my fellow directors?
I don't.
Could you just put the last slide up one more
The
time,
balance?
please? Okay, balance. Is that bullet number 2, is that due to that glitch that you
Yes.
mentioned?
Exactly.
Okay.
And we expect to receive that in March.
Thank you. I just needed that clarification. So no other further questions. We'll move on to our second presentation item. All right, Mr. O'Toole, please continue. Item 2, mid-year budget for 2025-26.
Thank you, Madam Chair. Well, the slide, here we go. Slide is up. Tonight I'll be presenting the mid-year budget for this fiscal year, 25-26. The main point of comparison, as I said earlier, is the final budget. And from that point of comparison, you will see that the changes in revenues and expenditures have been very small. Less than 1% in expenditures and less than 0.5% on the revenue side. That speaks to the precision of the budgeting that occurred this year. And with that, we'll take a look at an agenda. We'll start off with a mid-year budget overview and then drill in a little further on revenues and then expenditures, followed by information on capital outlay reflecting the infusion of Measure O. I typically provide a 5-year forecast at preliminary and final budget, but kind of given the context of where we are now, I've included in this presentation as well. Although you'll see the changes hasn't been any real significant swing since final, but presenting it anyway. There will also be an informational slide on the district's one-time revenue risks. There's something I wanted to present on, and then any comments, questions you may have. Slide. Can you give me a hand with this slide? Okay. There we go. Perfect. Thank you. Okay, this slide is your top line fiscal summary answering the questions about how big is Metro Fire's budget and how much reserve do we have. It includes the final budget adopted in last September, and the mid-year budget for your consideration tonight, and differences. That's kind of what you see in the 3 columns there: final, mid-year, and difference. Starting with the all funds, the gray box at the top here. So that's all funds in the district. The measure, let's see, Measure O expenditures are the reason you're seeing high expenditures there. So it's we're into the 464 million on expenditures for mid-year. Revenues are at 360, so just an increase of about 1.7 million relative to final. And other financing sources stayed about the same, just a small increase of 426. So the change in fund balance across those funds was, across all funds was just a difference of 2 million. So it's just a small decline relative to final. General fund, we have revenues, reporting revenues of 341.8. So that's an increase of 867,000 over final. Expenditures, 344.8. So an increase of 3 million. Other transfers, other financing sources and transfers was a $2 million difference. So that actually offsets those expenditures. So we see the change in fund balance is just $68,308. So again, very small change between between final and mid-year with revenues and expenditures. Projected year-end reserve amount is when the audit closed this year, the auditors found savings and differences of 5.4 million, which increases our reserve by about 1.5%. So drilling into the revenues and expenditures a little bit here, starting with revenues.
Mr. O'Toole, excuse me. I have a quick question on that first. And I do apologize. This new stuff is kind of jumping up at me and perhaps I'm misreading this, but can you help us out on the 25-26 budget? It says all funds and then we have the final. Now that's our projected budget, ending budget, right?
That was the adopted final budget,
Okay.
that column there.
And then we had mid-year, and so that's for our adjustments.
Yep.
Right?
Yes.
Well, quickly glancing, the mid-year is, well, if it's dumb, I'm sorry, I'll apologize ahead of time. Okay, mid-year's higher in revenues, mid-year's higher in expenditures, and then other financing sources is also higher. So how do we get to a lower number in the change in fund balance between final and mid-year?
If you add the revenues and the other financing sources together, that equals $68,000 less than $3,079,021.
So you were just looking at, you were not looking at expenditures?
No, the expenditures, the 68,000 is the difference between.
Where's the 68?
Sorry, the change in fund balance, 68,308 in the general fund box at the.
Okay, wait a minute. I don't see, where is 60, again, I apologize, but I don't see 68,000. Where is it?
So in the blue box, it says difference. You see that, and then look down 5 rows there or 4 rows, 68,308.
Oh, okay. Over here, change in fund balance. I was talking about all funds at the top. In the gray box.
Okay, so the all funds is, so all funds, the revenues increased by 1.7, expenditures increased by 4.1, and then the other financing sources increased by 426. So if you add the other financing sources to revenues and subtract that from expenditures, the difference is $2,045,000.
Okay, so we're under, we came up short $2 million.
On the all funds, we're spending $2 million less than we did at final. Exactly.
Wait, say that again, please.
For all funds, we're spending $2 million less than we anticipated at final.
Okay, and that includes all the revenues and all the expenditures balanced out.
Yes.
All right, thank you.
Certainly. Okay. So the projected general fund revenue of 341.8 million, which is a 900,000, 0.3% increase from the prior budget. Property taxes were anticipated to be 224.9 million. So it's about a $39,000 increase from final. Charges for services are estimated to be 109.1 million, 637,000 over final. Medic fees, let's see, anticipating those to be 49.3 million, which is actually about $1.2 million less than final. And PBGEMT has reached 27 million, which is $1.5 million, $1.5 million increase over final. So EMS went down, PBGMT went up. That bolded note there, I just want to be clear, there's no PBGMT reimbursement rate increases assumed in mid-year budget. Potential increase in PBGMT income income of roughly 6 million. So as you recall, the PPGMT program has rates that are set by the Federal Centers of Medicaid Services, and the participants in the program will ask for add-on rates. And we actually do this through the state's Department of Healthcare Services. So they've requested an add-on rate, and they haven't gotten a reply yet. And when I presented this in final, I was relying on the last time this happened, we got a reply in January, but we still have no reply. So I've not built that into the budget. So I know that's not an insignificant amount. I just want to be very clear that it's not there because we haven't had a response yet from.
Okay, thank you. And does that 6 million include the 1.5 already received or no?
The 6 million is additional money that for an adjusted rate. So it's all new money.
Okay, thank you.
Certainly. Yep. And then the voluntary rate range program is at 17 million. So it was about a $500,000 increase relative to final. And CRD fees came in strong too, mostly plan review fees, about $1 million more. Switching over to expenditures. Let's see, projected general fund expenditures of 344.8 million. So that's just about a 0.9% increase from final. The labor budget, which includes compensation and benefits, was 275.5 million, which is just a $2 million increase over final. Labor budget does include 6 firefighters that would be effective on May 1, 2026, a shop assistant, a helicopter mechanic, warehouse supervisors, and a facilities tech. Labor costs will be 80.2% of general fund revenues. And services and supplies was up by 1.2 million, a 1.9% increase over the final budget.
And the services and supplies due
to there's some utility pieces. There's I've got a slide coming on that if I can show you that there. Okay. But focus on and next on expenditures from labor, which again includes both compensation and benefits. On the compensation side, again, it was up 2 million. Lots of things happening underneath that $2 million change. The wages were $3 million lower, mainly due to vacant position savings. So we budget all our positions as full, including our pool positions, and didn't fill all of them. So there was some savings there. Constant staffing kind of going the other way, higher than expected, 6.1 million. Incentive pays, which are tied to that wage pays, those were also lower because we had fewer people to pay, saved 700,000 there. And I just note that the employee behavioral wellness incentive was about 3.1 million. So we over budgeted that by about 200,000. Total benefits, 121 million. Notably, there was savings on employee medical costs, about 810,000. Going the other direction, workers' comp costs are 1.5 million. That's mainly due to some anticipated higher payouts this fiscal year. And there's that service and supplies slide. So yeah, what were those differences? Big pieces making it up were building services, just coming out of the general fund, the cost for that. There was also utilities, electricity, natural gas. There was an increase in dispatch services. They had a new contract and increased the amount that we contribute there by 324,000. There's also an increase to district PPGMT match to draw down those federal funds. So when I talk about PPGMT, we have to remember that we do put up money to pull down money. That went up since final. This capital outlay summary is just a quick reminder. So total spending at 104.4 million on capital outlay, 75 million of that will be coming out of the Measure O building fund. Some notable projects are listed out there. So Station 67 gets 6.4 million from Measure O. Down below, it also will receive 9 million from the Development Impact Fees Fund. So drawing from 2 sources. 25 ambulance replacements, 3 trucks, 15 type 1 engines, type 3 engines and dozers and so forth. Other capital outlay projects that are funded not from Measure O, Grant Line 220, Zinfandel, Fire Station 67 I mentioned, and from the Special Projects Fund, also contributing 10.6 million to that phase 3. Now moving on to the forecast, I like to start this with some assumptions and just being clear what those are. Property tax. So we use our property tax data we get from the county, and we share it with our consultant, and they provide projections. That's how the projections of the consultant are basically how we do that. We also include what we anticipate, what we call natural growth, which would be anything from step increase. It's everything labor related that goes up on its own. So healthcare costs, pension, workers' comp, potentially step increases, all that. That averages about 2% a year. So we included that in the projection as well. Didn't factor in any wage or staffing increases, just kind of holding that as it is. And PPG and VRP increased approximately 2% annually. And then the pension costs were grown at the rate that CalPERS projects for us. I just pulled out of their evaluation the rates that they project for the next 4 years. And this is what it looks like. What this in a chart form. Dollars are to the left side, and then reserve percentage is off to the right. And as you can see, the amount of general fund reserves, the blue column declines over the 4 years with a slight uptick on the 5th year. At the same time, district expenditures are growing slightly faster, so the reserve ratio, which is the green line, is gradually declining. Reserves are forecasted to be 10.8% in 26-27, getting down to 8.6% in 28-29, and staying at 8.6% in 29-30. Interestingly, and again, this is a 5-year forecast, so the numbers will not be precise. 2029-30 is the first year when reserve borrowing would not occur under the assumptions used. So all those previous years would involve additional years of reserve borrowing. For reference, the red line at the top is where that 15% reserve would be. So you can see, kind of get a sense of relative difference there. And again, I pointed this out again, the PPGMT add-on increase I talked about is not included in this forecast. This next slide is a new one. I just kind of wanted to share it with you and this committee. It's something I haven't done in a while, probably worthwhile to look at what our one-time general fund revenue risk is. So all agencies have one-time revenues, and the goal of this slide is to convey our exposure to if those one-time revenues were to go away. When an agency has a large amount of one-time revenues, they can risk sort of turbulent budgeting when that gets lost. As a share of our budget, the district's exposure to one-time revenue, I think, is pretty small, just 18 million as of our final budget, and that's about 5% of the total budget. The box at the top left shows this year's exposure by source. There's basically just the 3 sources listed there. The VRP program is listed as a one-time because it doesn't have a statutory authority. If we decided to pull out, or the plan providers, the insurance companies decide to pull out, or the state as a participant, or feds decided they didn't want to participate, it could go away. So I listed here, but yes, it's been around for a decade too. But it does technically qualify as a one-time risk. And it's about 90% of it, to be honest. We listed below voluntary rate range program, and the box at the top left is MIH funding. So there's a contract there that is a one-time. It has potential to go away too. And then that fire prevention and safety grant is listed. So altogether, that's where you get for this fiscal year a one-time exposure, if you will, of 18 million. And then down below, the box at the bottom, you can see sort of multi-year projection of what that happens. So you have VRP, which we expect to grow. So the size of that risk grows by about, what do we say, 2% annually or so. And you have some other grants, including SAFER, which is, we've renewed it once, but there's no guarantee. So there's a one-time exposure there as well. And MIH funding, as I mentioned. So just an informational slide for you. The total, again, is about 5% of the total budget is the exposure. So mid-year budget summary. The district's mid-year budget substantially unchanged, like I said. On the revenue side, less than 3%. Expenditure side, less than 9% from final. So very close. There was a reserve transfer still necessary. It's $5 million and lowers the year-end reserve balance to 41.5. The general fund reserve itself increased at 12% based on the prior year savings identified in the annual audit. And the 5-year forecast shows modest reserve borrowing will continue through 28-29, subject to significant changes in things like property tax or labor costs and that kind of thing. And then, of course, Measure O continues to provide like significant support to the district, 75 million committed in 25, 26. With that, I welcome your questions and comments.
Thank you, Mr. O'Toole. Some very informative slides there. Appreciate that exposure slide is particularly. Any of my fellow directors have any comments or questions for our CFO? Okay, I assume we have nothing online either.
So there's like somebody in the crowd.
Oh, yes, thank you very, okay, hang on. Public
Would-
comment?
Would need to come up to
Come
the
podium.
podium. Otherwise nobody can hear him.
We're not done with this meeting yet, folks.
Right there in
We,
front.
we have a couple things lined up.
A question for Dave is labor costs. Is that all employees of the district or just 522?
All.
He said all,
Yeah, thank you.
just so you know. Thank you.
Okay, thank you.
Mhm.
And then I have two questions. Back on page, in my packet, it's page 46 about the 5-year forecast key assumptions. And we did discuss this earlier, and I appreciate you spending time with me. On the bullet number 2, it talked about natural growth being at 2%.
Mhm.
And could you please put a dollar amount figure for that 2%?
So I would have to, I'll have to get back to you on that. So it'd be, it would be in around 4 million or so, but let me get you an exact figure.
Yeah, well, we had discussed that earlier. I don't recall the exact amount either, but
Yeah.
trying to get the equivalency, we talk about percentages, and that is important for patterns. But the other part of it is when we talk about percentages, what is the dollar value associated with those things? Then my second question is, just came up to my brain here. Regarding the exposures for the VRRP, Voluntary Rate Range Program, I'm sorry, very briefly, lucky you, very briefly, how does this federal program work? Is it renewed annually? When do we know if it stays up or if it drops out?
So there are a few drivers, whether or not the federal government wants to continue to permit it and facilitate it. And as well as we have about 4 health plans that participate, whether or not they want to participate. We put up money to the state gathers all the local agency money, gives it to the federal government, and then they push down money. But when they push down the money to the locals, it's not just us, it's going to the health plans. So they're getting a share as well. And as long as it's sufficient for their workloads, that they feel like this is a worthwhile program for us to participate in, those health plans will participate. And actually and so to keep it simple, that's for as long as that continues, if all those parties are happy with how much they're receiving, then the program will continue.
And then what, if, let's say we put in X amount, X times what number do we usually get back from the feds?
Sure, it's about if we put in think of an exact number, if we put in 8, we'd get in about 16. It's about 1.5.
Oh, okay.
Yeah.
16,
yeah.
that's 100%.
100%, excuse me.
Yeah.
Yeah.
Okay. Well, thank you. And we'll keep our fingers crossed. And is this renewed annually?
It isn't exactly.
Feds, and when does it come up? What's on the calendar?
I'm hesitating because the program has shifted over the last couple of years, but we're in a pattern now where we are receiving payments in the spring. So, about the spring, right? Yeah, let's just say May or April.
Okay.
Yeah.
So,
Maybe a
well,
little
thank you.
earlier.
So we have something to keep our eye on for the next couple months.
Mhm.
No, very informative. Thank you very, very much for presenting that. All right. Do we have anything for the good of the order? 3, 2, 1, polls are closed. We are adjourned, and next meeting is May 28th in these chambers. Thank you.